Institutions own 3 or 4% of the stock. They're trying to make this a lightning rod issue. It's not a big deal. I count 7 or 8 times since 2012. It's never resulted in legislation, by the way. It's a talking point that they use as political banter and political benefit. Trump said it's not like a law, it's just guidance. I differentiate very clearly that build for rent and SFR is not the same thing, not at all. Anyone that owns a home knows that after the first 4 or 5 years, you're always fixing something new. They're spending $3,000, $4,000 a year on maintenance. I'm spending $200, $300 a year because my homes are.
Ryan, you have institutional clients. What are you hearing in the industry about this Trump stuff?
Yeah, it's a great question. A lot of what Mark said is
Hey everybody, this is Adam Stern and Ted Ferry for Unleashed. Wanted to keep us off here and say, hey, how's it going, Ted?
I'm doing great. Amidst everything happening in our industry right now, I'm doing as good as I can be.
A lot of interesting things happen, man. A lot of people have a lot of opinions about what's going on in the market right now, coming off this kind of tweet from Trump and the Davos meeting he had, and the feedback he was giving on institutional investors either being locked out of the market or being allowed to participate in the whole bill for rent segment. So should be interesting. I've got my view from the brokerage perspective. You've got your view from the principal perspective over there at Homestead Affordable. I brought in a friend of mine, long-term colleague, guy that runs a sizable company called AHV Communities out there in the West in a bunch of different markets all over the country. His name is Mark Wolf, and wanted to have him kind of sound off on what's going on from an operator's perspective and the perspective of someone that operates large-scale build-for-rent communities, and kind of what this new reality looks like on the press, on the heels of the administration making this announcement that, yeah, build-for-rent's probably not something we're going to lock institutional investors out of. It's probably going to be contained to retail kind of sales, and I'm curious to hear what he's going to have to say about that subject as an operator himself.
100%. I'm very interested to hear what Mark has to say and have the conversation. In general, I think what the goal of the EO and everything, it's all good for the country. Affordability is something that I think we all want. It's just, I think the real kind of like thing to deal with now is just the effect that it has on the industry in the interim and over the long term. There's generally a lot of misconceptions around the effect that institutions have on affordability. And I think it's just another iteration where we kind of have to, help bring people up to speed and share data. There's been a lot of really great data in the market on LinkedIn and posts since this came out that highlights how the effect of institutions on affordability just kind of really isn't true. And so I think it's, conversations with people like Mark here that can really help us to highlight what it means for us in the industry in the near term and the long term.
Yeah, listen, it doesn't behoove me to say this because my brokerage sells a lot to institutional investors, but like the idea that the administration is paying real attention to the affordability crisis in this country, as misguided as it might seem, pointing the finger at institutional investors as kind of like the starting point for all this, which I don't think is the case. But like the idea that the government's going to do something to make housing more affordable. I was actually pleased to see that, they were veering toward making the ability to get financing for certain kinds of investors a little bit harder. Securitization is a little bit harder to do instead of actually restricting buying activity. But yeah, it should be interesting hearing what Mark has to say because like he's an operator. He operates in a bunch of different markets. He'll eventually be a seller. He'll eventually be a buyer again. And it matters. I'm wondering what this all means to a guy that runs a company that size and with that focus.
I agree. Bring him on.
All right, let's do it. Mark Wolf from
Everybody welcome.
Yes, there he is. Mark. Good. Big guy. How you doing, man? Good to be here. Thanks, guys. Good to see you. So we kind of preempted this. So that everyone knows kind of what your background is, what your focus is. You want to just give us like a minute on who you are, where you got to where you are, what HV does?
Sure. Well, I'll start back at the beginning. Out of college, I went right into banking, doing some credit risk management and then institutional lending for office products. I found myself into the mortgage banking, investment banking world shortly thereafter, where I just put deals together for years. I found a love and a focus for multifamily. So up and through the Great Recession, I was focused on putting deals together for multifamily, both debt and equity. And then the Great Recession came around. Everyone had to rethink life. I kind of saw what was going on in the single family world where they were aggregating product type. And I had been out trying to buy some value-add apartments for my own account. And that's kind of when I got the idea. I actually got to see a couple portfolios because it came from the finance world. I actually saw some portfolios that people were trying to finance, and I got introduced to a few of them. I got to look at their operations. And so I was seeing how like great this product was from a desirability standpoint, the single family aggregation platforms, right? 800, 900 units in Houston. But one thing that kind of rang true that through everyone's platforms, and back then, there were no apps to manage your portfolio, right? It was very different in 2011, 12.
Yeah.
And so I kind of saw this void of operational fortitude. And that's when I came up with the idea of this build for rent communities. And I said, man, if you could just build neighborhoods, single family homes, new build, so they weren't old and full of, repairs and disrepair. And they were contiguous and cohesive in nature, slapping a management component on it, right? And you could operate this thing like an apartment. And that's hence where the build for rent concept came from. It was really just merging the best of both worlds, seeing what was going on in the aggregation world, my experience in the multifamily world, and understanding that desirability of being a home, right? Everyone wants to be in a home. I don't think everyone should own a home. Certainly, I think everyone should have an opportunity to live in one. And so that's when AHV kind of became the start. I guess the impetus for AHV. Today, fast forward, we're a builder. We're vertically integrated. We felt we had to control our own destiny from a build perspective, from a cost, quality, transparency perspective. So it's been a crazy journey, but my roots have always been multifamily, and we're back to our roots doing multifamily as well as build for rent. But it's been a crazy ride for the last 13 plus years. But that's the genesis of HV and my background.
That's interesting, man. I came at the SFR industry, and when I started, it was all about institutional investors buying foreclosures and then turn them into rental properties, and then like aggregating not new construction, but like existing rental property portfolios from like smaller operators and from the MLS. And I saw it kind of go through build for rents because like that got too expensive. So they started buying market rate houses, and eventually market rate houses became more expensive than building their own houses. And then I saw the whole build for rent thing from the other side where I
had a similar experience, Adam. I think in 2012, supply really wasn't the issue, right? So, just hearing your story, Mark, it's very interesting because it must have taken a tremendous amount of ambition to bring supply to a supply-ridden market. And, it was really, strong pioneer, right?
Yeah, look, it's my thing was, how do you manage 50,000 houses and 50,000 locations, right? It was an optics game. And then not to mention, most of these houses on these tapes they were buying from the banks were, 20, 30, 40 years old. So anyone that owns a home knows that, after the first 4 or 5 years, you're playing chase the tail, right? You're always fixing something new, which is why all these aggregator guys, the Invitation Homes and Tricon and, American House Rent, they're spending $3,000-$4,000 a year on maintenance, right? I'm spending $200-$300 a year because my homes are brand new. And that was the thing for me, is like just building brand new homes that you can manage, right? It's a better mousetrap. And then obviously fast forward to today, build for rent's a very big component of all these guys' platforms.
Yeah. I would guess like it's a different pitch to investors too, because if you're an American Homes for Rent or even a smaller operator, you're kind of promising, hey, we'll efficiently manage these disparate properties over a portfolio better than you ever could. Your kind of pitch might be, I would assume, different to your investors, where like they're already investing in multifamily, and all they're really doing with build for rent is essentially the same thing, investing in a multifamily-like product that's being managed in a single location by a single operator. So it's almost like a separate product type within the SFR realm that's more akin to multifamily than it is to like SFR portfolio operations.
Yeah, look, I differentiate very clearly that build for rent and SFR is not the same thing, not at all. And I will always believe that because of my background, by the way, and my model, not all build for rent's equal. We're very much keen on location, product, management, maintenance, and amenities. So that is always something that, look, we trademarked build for rent. You can look it up. I trademarked it. I used to talk to agent commissions and zone that. Yeah. It's our trademark. Because I used to explain to
BPR now instead of BFR.
Do I have to pay you anything? I would be built for rent all the time, dude. I never knew.
It's hard to enforce, but we own it. You can look it up. It's and actually build to rent and build for rent are both covered under the same thing. But look, at the end of the day, we have a very specific approach to the business, and it's management, maintenance, and amenities. It's multifamily, right? We are the extension to multifamily. You have your studios, 1s, 2s, 3s, and now 4 bedrooms, right? Very few apartments have, more than 7 or 10% 3-bedroom. Predominant unit mix in build for rent is 3-bedroom and some 4s. Over the years, we've gotten keen on developing a 2-bedroom home, but you have still a 20%, 15% of our community count, our communities. So you have, 20% 2-bedroom, 20% 4-bedroom. The bulk of it is, the rest of it is, the 3-bedroom. And that really is an extension of multifamily. Then you go to your investment pool. Who do I sell to, right? Who buys this and operates it? All the multifamily REITs can easily come in and buy, manage, and add this to their, offering. Any investor, high net worth or syndication, can come in and buy one of these communities as well, because it's very familiar, as you referenced, madam. Yeah, it's a familiar operational platform. So it's like,
I've always been interested in, I think you have the unique position of having the history to see how this played out. You mentioned that the maintenance profile on a BTR community is lower because it's new construction. But now, like, how does the maintenance profile, what does it look like today on like that 2012?
Well, I didn't get my first community up until 2015. We're busy buying dirt. So we're a holistic developer. We identify the land, design it, develop it, build the houses, lease it up, operate it. So finished my first community 2017. That community to this day still operates at 93, 94% occupancy. Maintenance has crept up a little bit. The turns are a little bit more expensive, but we're still approaching, 7 years operations, 8. We have a very specific approach to our products when we build a house. These aren't really like, no disrespect to the big home builders, but the big home builders, Lennar and Horde, they don't build a high quality home. They build a lot of homes. So our materials, our spec materials are better HVAC, better roof materials, better flooring, better countertops, better drywall. Everything is just a little bit better. I liken our product to more like first move up quality home. So you get a little better wear and tear out of this product. And so, our HVAC systems they're upsized a half a ton to a ton. So they cycle less, last longer. Our insulation materials are better than your entry level. So it's not, your house is more balanced over a longer period of time. So our HVAC system shouldn't be working nearly as hard as a normal production home level would. And therefore that should extend the life cycle out. Plus these come with a 7-year, kind of warranty. So those are some of the nuances why I still think we're operating at very low levels compared to, some of the older stock, just because we inherently built a brand new home. Yeah. Right. And we have these warranties, and we approach this business with better electrical harnessing, better plumbing, fixtures. We spent that extra $1,000 on a house, $1,500.
Right. Like your production management would put you in a place where you're operating better because of what you've done the entire way through. Whereas like if you maybe compared to like a scattered site in purchase, or even a new construction purchase, you don't have the benefit of being able to control that throughout, right?
Yeah, correct. We're very intentional, about what we do.
So I want to bring this back to kind of the news that came out, over a month ago now, with the administration saying they were going to try to lock out institutional investors from the residential housing market. And to start off that kind of idea and talking about that, like your units, you built a high quality unit, and you're looking at long-term operations and the cost to operate those units is kind of the reason, other than the fact you want to build nice houses for people to live in, it's actually more operationally efficient for you to use higher quality components so that your maintenance and, maintenance cost is stable or doesn't tick up over time. So like my first question is like your view of what you built, you never intended these to be, and probably never will be, retail sold units, right? Like this is a single thing that you're never going to break apart and then maybe sell one off, which makes me believe kind of the idea that the administration came out with build for rent being the exception, kind of making sense, because you're not competing against home buyers for retail units. You're basically, what you built is a multifamily-ish apartment complex that just happens to be single family. Just your thoughts on that in the context of what the administration is saying about build for rent and the lockout.
Yeah, that's great. Look, the intent is never to break them up, but it doesn't mean we can't. We always can. That's the beauty of, I think, our product. When you really look at it, it's a great investment vehicle for anyone that wants to own multifamily. However, as a risk mitigant, as an alternative, you could sell these off as individual homes in a very country club-like setting. that was always like just a risk, mitigation. But the intent is to run these things as an operation, as an apartment long term, right? With the widget being the single family home. I think that the build for rent concept, really, the reason I came up with the term build for rent is because I was explaining to these planning commissions and zoning boards and neighborhood, looky-loos and people who were pissed off about apartments is I said, listen, these houses were never going to be for sale. They were always going to be built for rent. So why are you upset about that? Like, you shouldn't care if Bobby and Susie don't have the chance to buy this home, because I was never going to offer it to them anyway. It was never for sale. And that's where the term built for rent came from. It came from a simple explanation to people who were upset that they wanted homeowners in their neighborhood. And I said, well, I'm just building something for rent. So it's not available. So why are you upset about this, right? It's my right as a landowner to do this. And so it just kind of stuck, by the way. John Burns, I explained to him one time and he ran with it. Next thing you know, it was plastered everywhere and it became the term du jour, right? So I think the administration is right in some ways, right? We saw in pockets of high growth, high velocity, parts of Texas, parts of the Southeast, where Wall Street was coming in and buying houses. And once Wall Street wants something, no one can compete. You can't compete on speed. You can't compete on price. And frankly, they also carry leverage to buy a house cheaper because they can buy so many in bulk. And at the end of the day, Lennar and Horton and all these big groups are just looking to sell widgets, man. They just want to move those widgets. And if they get a little bit of discount to move a lot of product, looks great on the sales sheet. Hence the stock price goes up, which is worth way more than selling a house, right? Yeah, let's be honest. Selling a house for $1 more or selling 100 more houses quickly, what does better for your stock? So I get the rub because those houses are chartered with those companies historically have been the sole sales point for entry-level housing to Bobby and Susie. So when Wall Street comes in and buys in mass, I get the rub. I get why Congress has mentioned this 7 or 8 times since 2012. It's not the first time that someone's, kind of come up with like, Wall Street's the big bad wolf and shouldn't be, able to do this. This has happened. I actually got asked to come on the 2022, I think it was a Warren hearing or something like that on housing. I denied it. I said, no, thank you. I don't want any part of this. Sure. But I do understand the rub. I think it's a slippery slope because this is capitalism. I'm an American. I love capitalism. And I think that when you really peel back the onion and say, what impact has this had on, home ownership? None. Institutions own 3 or 4% of the stock. It's not a big deal. They're trying to make this, a lightning rod issue, and it isn't. The build for rent is a very easy off-ramp because these are intentionally built for rent. And I think it's good for my business in a sense because the headline says Wall Street's probably going to pause a little bit on buying. And they're going to look to say, okay, where do I play safely as this kind of shakes out? And where they play safely is in the build for rent guys. And there's only a handful of guys that really do it well, that do it big enough for Wall Street to put, big checks out. So I think it's good in a way for the business, but it's going to cause a lot of problems on the SFR side, the retail outlet side. I think it's going to be pretty interesting to see how that shakes out.
I think it's kind of interesting, the point that you're saying about the effect of being able to, the effect on a public stock price on being able to sell 100 homes versus one. But like, if you take those two buyers, the retail buyer, owner occupant buyer versus, let's call them like just a large investor. So we don't have any loaded terms that are getting thrown around here. But, if from the builder's perspective, they would prefer to sell 100 retail to owner occupant versus selling to the large investor, right? Because there's tremendous amount more margin.
Yep.
Right. It's like that's like they would prefer that because there's more margin. But I think why so many homes, why it makes sense to sell to large investors, that bid's not there, right? Like it's just.
Well, I don't disagree entirely with that, but at the end of the day, that incremental margin happens very slowly. So at every phase, every 4 homes, they kind of tick it up. And don't forget, when institutions are coming and buying, there's escalations. There are things that help them, and again, you probably sales cost, less friction. So you have, you can reduce your price net 3% or 6% and make the same money, the same margin, because you don't have the sales cost. You're coming in with a bulk purchase of 100 instead of 100 individual transactions, which has a lot of friction, right, on the execution of that. Yep. And again, the math isn't probably specific, but generally speaking, if I could sell 100 to one group and make almost the same money, I'm going to, because it's easier and I can go on my way to do another 100.
Right. I think I'm digging in on the point because I think one of the things that's been said out there is that, the large buyers are taking away opportunities from owner occupants. But I just don't see builders operating like that. I think that they're offered to the owner occupants first. And at least for our platform and what we do, the buying that we do, Like we're the backup buyer, right? I mean, we're helping them turn their capital, keep crews working, and and move volume. But whatever we come with pricing to start with is never the first bid they're going to hit.
Yeah, this is also, I think, again, a brief window of craziness during the COVID chaos that we all experienced, right? There was nothing good from the last 5 years. We're seeing that right now. We can talk about that after this topic, but there was a brief window there where, Wall Street and everybody was just price family escalation, explosion, houses going. I mean, I had to pay. My trades were coming to me every week saying, I got to charge you more money because Horton's going to pay more to frame that house down the street. So you got to pay up. Because everyone was so busy, right? Because they were selling in bulk to anybody and everybody, both individual buyers and Wall Street. But that's a small window of time. That's 12 months, 15 months. And they're trying to pretend that Wall Street's bad. It isn't. Like I said, I think it's disingenuous what they're trying to do, because I agree overall. But there was a period of time where Bobby and Susie could never compete against any of the Wall Street firms because they had the biggest checkbooks and they could write it the fastest.
So,
but it was a brief window. It wasn't like it's a 10-year period. This is like a small window.
I agree. And I saw the craziness that happened between COVID and like the few years after COVID before interest rates went up. But I also see it from the other side. And I guess here's my view on it. If the goal of the government is to get institutional investment capital out of the residential housing market so that they can protect consumers and not have them compete against that capital, aside from like build for rent, if you think about like the Lennars, D.R. Hortons, and even like small regional builders of the world, and they're selling their homes at a price, let's call it, a $400,000 house. And there's an option to sell that same property for $360,000 to an investor. They've got kind of this alternate option that wasn't there before institutional investors came in. They would have to say, all right, that $400,000 house I was going to sell on the market, I'm going to take it down to $380,000 because I need to sell it. I can't keep it in my books. Now they're like, well, I can sell it for $360,000 to this other group. And I guess my view is that is happening. Like especially smaller dealers that can't carry the cost of financing through like a year or 2-year disposition and just looks at the institutional investor capital as kind of their exit ramp. Maybe they're not going to make a lot of money, maybe even break even, but it kind of creates a disincentive for them to lower prices on the retail market because they kind of know where that floor is. And I guess it makes sense to me from the perspective of if this capital was basically excluded from the market, it would put builders in a really tough position because, they can't do anything about the units they, bought the land for, built the lots for, built the homes for. They're just going to have to take a hit and let the pricing of the market adjust what they can get for them. That's if like institutional investors, not excluding build for rent, get excluded from buying homes from builders that would normally go for sale. And I guess
what you're kind of talking about is like an appraisal issue, right? Because the sale to retail versus the sale to like in a portfolio, it's different by an appraiser.
I get that, but I also know that from a builder's perspective, they had a number that they need to hit to break even, right? And the rest is their margin on top of that. The big question I'm trying to figure out, or at least talk to you guys about, is the presence of institutional capital for any kind of residential products, excluding build for rent, like new construction homes on the builder side, or even people that have large-scale SFR portfolios where they can't sell to institutional investors. What's going to happen to that inventory? It's not naturally going to be vacated, and then that it's going to end up going to the retail home buyer. And that, for a guy that sells the majority of what he sells from smaller operators to institutionally backed funds or even private equity backed funds, that's a scary idea, not only for me as a broker, but also for like people that have 10 properties or 50 properties or 100 properties, that their only exit option to sell their asset is to a private equity fund backed operator or an institutional backed operator. Does that solve the problem at the end of the day?
Yeah, look, I think it'd be a mistake to legislate against the ownership participation because I do believe it's been overblown. It has a few moments in time. It's been very, obvious. But when you look at it's not like it's an antitrust movement where you have 70% of the market is captured by, these Wall Street guys. It's still a very small percentage. If you're starting to approach 20% of the housing stock, you might want to start to get concerned. Yeah, but when you're talking about not high single digits, low single digits, we're talking about 500,000 homes, maybe 600,000. This is a number that it's paltry. It's paltry to $72 million sector.
Already have the strongest concentrations too, right? I mean, naturally the number is extremely low. It doesn't even come on the radar. But you look at a place like Atlanta, I mean, you're still single digits, right?
That's right. So I do believe this is, again, these like I looked up and I did some research before we got on the phone, because I count 7 or 8 times since 2012 where this has come up. And it's never accounted for, it's never resulted in legislation, by the way. It's a talking point that they use as political banter and political benefit, and it goes by the wayside. Trump has come out, but by the way, what Trump said it's not like a law, like saying this is this. It's just guidance that there's been nothing really done since is saying we're going to limit this. Like, okay, well, what's next?
So I guess the question is, like,
One of the toughest things for the industry though is that it has a chilling effect, and it, like
100%. You saw that already.
right. We saw this last March with the HUD restructuring talk. I mean, there was a very well organized plan to go do the HUD restructuring. By the time it came to the one big beautiful bill, none of it, not a single piece of it, made into one big beautiful bill. Then you had the budgets, and then what happened actually with the budgets was that rental assistance payments actually increased. But so at the end of the day, there was literally no change, but you had to wait 6 to 9 months to really get to that conclusion.
It like I said, definitely had a chilling effect. You saw it almost immediately. There were groups, and I won't name the names, but several predominant Wall Street firms have absolutely just put the brakes on. And one of them was in closing on a deal, and they said, "Yeah, we're not closing." And it's like, whoa! I mean, this is a built for rent community, by the way. It was a contiguous, cohesive community, new build, and they said, "No, we're not going to, because we don't feel good about the political environment."
so when you saw that, Mark, when you saw that and you see big firms making that decision, and your company owns and operates large scale build for rents, like, does that change your perception, or does it scare you, or does it change anything about the way you operate today, thinking that, like, it's not likely, and maybe it's just conversational points and they're just blustering, but do you have to figure that into any bit of what you're doing today in terms of buying new projects, how your investors see the exit opportunity for the project that you guys already operate?
Yeah, so I think the build to rent exemption is very clear, and I think we are very definitively built for rent. We are typically a single plat, like that is intentional. It does a lot for the development of a project, and we can almost always condo map what we're doing anyway for individual lot and block to the extent we want, but we like the single plat. So that's one thing, very clear. That's kind of exempt in this whole EO. The second part of it is we're managed, maintained, and amenitized almost exclusively. Every project I've done 35 projects of both for sale and for rent. I think 21, 22 for rent communities, maybe more. Almost all of them but 2 had a management, maintenance, and amenity component. You look at my portfolio today, I have 1 project without out of 18 projects, I have 1 that doesn't have an amenity package. So we really are a multifamily optic. It's just a different widget. So I think I'm very exempt from this. I'm in the safe zone. Not everybody plays in that. Built for rent's not equal, right? Built for rent became an acronym that everybody used for everything in the world. Like, doesn't matter what you were selling, is throw built for rent on there and you get an extra 50 bips. Those days are gone. I don't take umbrage with it, but I define built for rent very differently and specifically. And so I think we're very safe, and that's why I feel good about this to a degree, but I also think it's a bunch of bluster. I don't think much is going to come of it, to be honest.
How do you view new capital coming in as a result of this? Like, do you view that as competition? Do you view as this kind of like, it's like a, big wave that you're all contributing to, or what's the net effect on your business?
Well, I think there's a narrowing of focus in the built for rent space. There's now a delineation between quality and product, location. For the longest time during the crazy cray days of COVID, right? It was location went out the window. Like, fundamentals of real estate are location, right? Those are the things we all learned. Today, it was just how fast can you get it up and sell it to somebody, and that you're seeing a lot of that residual bad product, bad location in the business. It's bringing the whole sector down. You've seen people leave the space. There are still people that are going to fail tomorrow. I think there's going to be a leveling out of the playing field, and I think the next iteration of this business will be more focused and more attentive to certain key attributes, which capital is going to require to get in the business, because a lot of capital that did get in the business got hurt. I have a fairly large portfolio. It's not doing great. I'm a very honest person. I feel terrible that I'm not hitting the returns I wanted to, because of, and it took longer to develop and it cost a lot more to build. And then now the markets are soft and everything that worked against you is working against you. but a lot of my capital is long-term and patient, so they'll see through to the, the 10, 15, 20-year hold, and they'll be fine. But some of the shorter-term players are going to be impacted by that. That's the game. That's real estate. So I think that capital, the next go-round, the next 10-year cycle we're about to embark upon, whether it's, 6 months or a year from now, is going to be way harder to, access that capital because it's going to be smarter and more disciplined, and the expectation of that deployment of that capital. So I think it's going to be better. There's going to be fewer players that are actually able to obtain that. And hopefully we're one of those groups, right? We have a lot of experience. We have a vertically integrated platform. Our locations speak for themselves. But you can't outrun a bad market, and we're in a bad market right now.
Yeah. Adam, how are you seeing it in your business? Have you received any inbound inquiries or anything like that for land or anything for build print communities from new capital based on kind of this carve out?
Oh yeah, like especially for my regional builders, they're spooked. They're spooked right now, and like just what Mark was talking about, like you're given the current position of the administration, you're kind of safe because you have single site, you're amenitized, but like 30% of the housing market is investors, and mostly small investors that own one or a couple of rental properties. And like builders and that group of like small investors, if institutional capital gets locked out of the market, that's a huge part of what their exit plan are. They call me all the time, and I'm the guy that gets that inventory out to the institutional investors and the smaller private operating firms. It's almost funny to hear your view of how you're safe, in terms of like the product you own and how you manage it and how it's built. Because what this administration's move might be, if they lock out institutional investors in any major way from the market, it's really going to hurt the smaller guy. It's really going to hurt the portfolio owner that owns 1 or 2 or 50 properties where they could have sold it to a private equity-backed fund that aggregates SFR over multiple locations, but now they can't do that. And a lot of that inventory has single loans on it where that's going to come due, and they're not going to be able to sell it one by one. So it's a real problem. And I hear the strain in the voices of my builders where they're like, all right, I've got this project. I don't know if this is going to be safe over the long term. A few of them give me looks at projects to sell, smaller 45 unit, 50 units, non-amenitized. But it certainly also affects them on the side of like buying lots and land where like they might have bought a small community or an assemblage of like 10 or 12 lots. And now they're thinking, well, if I don't have the opportunity to like build that and have a backstop against institutional investors buying it, I'm relying on the residential housing market, and that's going like shit right now. I can't rely on that. Things aren't selling, especially townhomes in certain markets. So I think all in all, this is affecting smaller operators and smaller builders more than it ever is larger scale operators like you, Mark.
Yeah,
Good. Yeah, no, I just the kind of trailing point. It's like the goal is to reduce competition, but I think the reality of that reduced competition is if you remove a buyer from the market, then people are gonna, you can't count on that buyer. So you're actually gonna end up with less supply because people are gonna build less.
Yeah, and that supply, some of it's gonna end up going back to banks, and banks are gonna basically do what they do, which is get it off their books as fast as they can for the best price they can, and whether that's gonna be residential home buyers buying is anyone's guess. It would take a lot of like management and restrictions by the government to say you can only sell it to these people, and then banks are going to push back. So, Mark, I don't know if you
think about it, right? Yeah, think about it, right? Because the very people that bailed the banks out was Wall Street.
Yep.
By the clearinghouse, right? They had to dump product, and it wasn't like the three of us on this web podcast. It was Wall Street coming in and saying, "Oh, we'll buy those 500,000 homes from you."
Yep. And it wasn't home buyers. And what would that have looked like if the government was like, "You can't buy these"? Were the banks going to let that happen? Would they have said the government would? If the government said, "Hey, you can only sell these to home buyers," would that have a ripple effect? What the ripple effect was going to be on banks and on the price of those units just dropping, and every home buyer.
Yeah, we watched multiple years in a row, like at least 2 years of 10% housing value loss nationwide, right? And it was when the large rental buyers came in that really propped that up and created floor, right? Yeah.
Yeah, look, I don't love that Horton and Lennar build, massive 100, 200 unit pods in the back of their, 5,000 unit neighborhood that, rents for $350, $450 less than my units because one, they're not as nice. Two, they're not as good a location. Three, they don't have amenities or management or maintenance. And so all that comes into play. And like, but at the end of the day, like, okay, I don't like it, but the government should legislate it, right? Like, this is capital markets. It has a way of working itself out. And I'd hate to see this reactionary kind of political environment that we live in, this, nonsensical political environment, just legislate stupid stuff like this. It's an overreaction. It's an overreach. And I don't know why. Trump, of all people, I was shocked when he came out, and I'm a Trump guy, but I was like, ooh, why are you waiting? Why are you waiting into this end of the pool? It doesn't seem like it's a smart move.
Such a huge surprise. I was not expecting anything remotely close to that.
Oh.
Adam, you have any kind of dropping thoughts here? I think it's been really great to talk with you, Mark, and have you on. Thank you. And I think that you definitely have the type of platform that the country needs to push forward housing, and for sure, I don't know, you continue to do that.
Hey, listen, I'm going to get my checkbook out and make sure that I write you a couple cents every time I use the term built for rent, and probably $4,000 a month at this point. So
look at that. We trademarked it. I don't know. It must have been 2016, 2017. It was like, yeah, let's do it.
Yep. So, Ted, we need to talk a lot about Homestead Affordable and what you guys do and what your view of the market is. We're going to talk more about that as we kind of go through this process of meeting guys like Mark and Aid, hearing about firms like AHV. I guess for right now, I think the consensus is things are business as usual. It sounds like this new move by the government is not setting a chill down your back, Mark, to make you change the way that you're operating now, or likely where capital is gonna flow in the future, right?
Correct.
Right.
Thanks for joining us, Mark. Great talk.
Thank you. Appreciate it.
All right. See ya. So we've got Ryan Killian here, longtime friend of mine, longtime colleague. I've known Ryan for more than 15 years. He's been a staple in the SFR space and now in the built for rent space. He's now president of Renew Management, and you guys are doing big things. I wanted to get your take on what's going on in the market today. Ryan, welcome to Unleashed with Ted and Adam.
Yeah, thanks, Adam, Ted. Great to be here. Grateful to be here. Appreciate all the content you guys are putting out there. Really insightful discussion with Mark just now. Really enjoyed that.
Yep. Yeah. It's interesting. You hear from like large scale operators, and I always think about like independent property management firms and how you have a totally different solution than what's single site or guys like Mark do in terms of internal management. And I was always curious kind of what the delta is between like what you guys do at Renew Property Management and kind of, is there a difference between what working with a firm like Renew is and someone internally managing either a large scale SFR portfolio or even a built for rent project? Maybe you can kind of give me a high level on how you see that difference.
Great question. I mean, really, honestly, to put it very, very simply, what we're trying to do is for third party PM is behave like an internal property management function. It's like Mark just described, right? You've listened to the beginning of how he went through how they've been successful, and he was honest about, not hitting returns that he's expecting to hit yet, but why he's still afloat and still in the positive and still doing well is because he's got operational excellence. He's vertically integrated, and he's able to control the outcomes by reverse engineering the process to those desired outcomes, all the way from underwrite, site identification, thinking through exactly the finishes and vendors he wants to use. And that's how he keeps his maintenance and turn costs low, even in year 7 and 8 of his, portfolio. What Renew prefers to do, and we as you know, Adam, we started on the SFR side, really identifying and underwriting one by one SFR acquisitions and portfolios, and then we built our property management function around that to be able to scale as a third party property manager. What that forces you to do, I think Mark said something about how do you manage 50,000 locations, right? You do it by having a centralized model. You manage decentralized assets by having a centralized model. You put very little on the ground. Only what needs to be done on site gets done on site, and everything else gets done remotely or in a central office. As we've gotten into build-to-rent and even now multifamily, we've been able to leverage that, to be able to make these, pro formas and ultimately the NOI, to maximize the potential. Because that's the only thing you can control is operational execution, right? You can't control the macro side. You can't control an executive order that says you're going to stop, you ban it, investors. You can't control it. You can't control saturation, at least not at a ground level, and declining rents. What you can control is your overhead. You can control your operational execution, what you pay vendors, how you maintain homes, your resident experience, those types of things. And leveraging, our centralized model, we're able to pass through savings to BTR owners and multifamily owners, that they wouldn't otherwise realize by, hiring a more traditional, multifamily manager that has in their mind that they're going to do everything on site. They're going to give you a pod of people, and, inherent with a pod of people that does every single thing on site, you're going to have waste, right? You don't need a full person to do renewals. You don't need a full person to do collections. You don't need a full person to sometimes lease. So you're going to have some waste there, and you're going to spend a little more money on personnel than you might need. What Renew's able to do is really kind of hone that in, handle whatever we can centrally, and then only, charge back to the site the overhead that's necessary to operate that site there. So for us to do that, we got to get plugged in as early as possible, right? Just like Mark's team, right? His entire operational team understands what the goal is. They understand the site. They understand the outcome that's been desired. They understand the assumptions. They're weighing in on those assumptions. They are iterating on those assumptions. So it's very seamless, right? And you could see and hear him listening to talk. I'm sure this is how their day-to-day goes, right? They're able to, to follow the, rigorous guidelines, and they've got a tech stack and, workflows that are geared towards serving his model.
Yep.
Smaller roofs that don't have that benefit, right? Or are never going to, it's not in their model or in their business plan to have an internal property management function. They've got to go find that same operational rigor and flexibility and adaptability without having to be part of the organization. And in some cases, not even be part of the initial underwrite and planning process. That's the difficult thing to do, right?
Yeah. I mean, so most of the platforms and operations that I've managed and put together all leverage third-party managers. So all of these things that you're mentioning are key value points from kind of like the operator perspective, or operator seat that I'm in. One of the things that I think was the toughest early on was really having real-time data, and to have the kind of vision to what's actually happening. How do you? I'm assuming you guys approach that with technology. Like, how does that work with your platform?
Yeah, we've got an institutional quality and grade asset management function, which includes reporting and data sharing, and we've got various different. We're on AppFolio, so we're using a typical property management function, but it's layered in and bolted on with custom workflow and workflows and CRMs, and all stitched together with Snowflake, right? So we've got real-time data surfaced in real time to all levels of the organization and, of course, the capital. So, if for us, the way to approach operational excellence is by gathering as much data and information as we can. And that's not just so that we can prove to the capital or their lenders how we're performing. That's to actually surface problems, right? So, we manage 7 different steps within the turn life cycle, right? We manage and measure them. And that's done by people in the field that are inputting data in real time. And then we're able to look at trends and raise flags and understand if there's waste going on. So that's just one example, but, project that across collections and leasing and, et cetera, rents, to be able to have all of that information and those data points, it allows you to make, more actionable insights, both pass through to the capital and say, hey, here's what we're seeing. Here's what's going to happen if we don't pull a certain lever. If we do pull that lever, here's some potentially unintended consequences. We can mitigate those. And it's all about that really acute kind of feedback loop. To your point, Ted, it's got to be fast and furious, and the conversations have to be had often. Otherwise, there's gaps. There's gaps in the NOI, there's gaps in your P&L, and ultimately, you won't be able to stay afloat when things get really hard and the macro side of things don't go well.
Yeah, I mean, like I used to always, this was, a gripe. I'll say this nicely, but like, I had communications with our accounting team, and like I had, one platform in particular, we would get our reporting like 90 days behind. And I'm like, what can I do with 90 days behind? Like we're like very far rearview mirror, right? So it's like the real time access to data is such a strong value point.
And I had a question about that. It's like I'm not on the property management side. I'm on the brokerage side. I broker assets. I even think about property management. I start to sweat. Like, it's an uncomfortable subject for me because I can imagine how hard it is to manage disparate properties all over the place. I was thinking the other day, like I have a blood glucose monitor that I monitor my blood glucose because I watch what I eat. So if I go on an app, someone's gathering data about what Adam's eating at any given time and what his glucose is. And I think about
Let that out.
yeah, it's awesome. Have you ever wonder about how your level?
Insane lunch yesterday.
Yeah, I ate like ribs with French fries. I went from like 90 to like 180 and then back down. And I was thinking like when I talk to portfolio owners, like they're always asking me, what the opportunity is to grow their portfolios larger and larger. I'm like, listen, if we were talking like 10 years ago, the technology today is far better for someone that isn't a code writer, doesn't want to build their own custom application, but wants to get better and better data because, you have iPhones and you have apps and you have all these back end systems that can help a property management company or a property manager, if you're doing it yourself, just do it better. And I was curious, Ryan, that like, I know that you have or used AppFolio bolted on with other custom software. Is any of that like put in the hands of actual tenants? Is there like a mobile component of this where you can actually get, real-time feedback? People want to like, do X, Y, and Z. They want their garbage picked up at a certain time. They want maintenance done on their house. How much of that has gone like mobile or at least desktop so that companies like yours can kind of aggregate that information and pull it into the mothership and make sure that you're doing the best for your owners?
Yeah, well, the question. I love the analogy you serviced. It's kind of to your point about feedback loop being a key. What if you're diabetic and you need to know when your insulin spikes? What's diabetic?
By the way, I just like the now in my whatchamacallit. Healthy's a horse, everyone.
But to take the analogy a step further, if you find out tomorrow that your insulin spiked today, does that help you? Right? No is the answer. Right? So it's a great point. And to your point about all the software, yeah, I mean, there's endless amounts of prop tech out there these days, right? There's so much cool stuff. I mean, obviously AI doing what it does, and you have to pick and choose, and you have to be thoughtful and mindful and really understand what am I going to get out of this, right? Short answer is yes. We've got lots of these mobile applications, mostly for our staff and team that manage these properties, right? You have to be able to not only have information, but be the gatherer of information quickly in order to make all these insights we're talking about in real time.
Yeah.
And without it, you're kind of dead in the water.
Yeah.
I'm a big fan of the 3-leg stool analogy, right? It's people, process, and systems. You can build the tech. You can have all these, hundreds and thousands of fields to house information that you get. But if you don't have a process and people that are trained on that process to go get the information in a reliable, credible way, and then an audit QC process to make sure that what you got is real and accurate, it breaks down somewhere in the middle, right? The stool falls over. So, yes, the technology is key. Yes, making sure you have cool widgets and use of AI, all of that stuff is critical. You've got to be on the cutting edge. You've got to always be critical of your own processes, procedures, and tech stack, but having the right operational rigor around it. And then, frankly, a culture of we're never done. We're never done fixing operations. It's never done. Anybody who says they are operationally efficient at 100% is lying. You're not, right? It's always that 0.1% more that you can get better. And some days it's more. So you've got to always be mindful of that and always in yourself.
Well, yeah. And so like, that's so interesting. Everything that you've been talking about so far, what I hear is an insane amount of investment and effort put into tremendous service provided to the tenant. And like, how is that? What is lost if you pull the institution or the large investor out of the market in terms of that service to the tenant?
That's a great question. I mean, look, it's this circles back to your question, or your conversation with Mark, I think originally, but, we need houses. I think Mark said it, not everybody should own, but everybody should have the opportunity to live in a house. And if you have these large swaths of institutional investors that get scared away from producing more rental stock,
yep,
owners are going to suffer. Options are going to be less, and they're going to, right now the resident is benefiting by companies like Mark and others that are in competition for their business. That competition breeds operational excellence and companies like us who are going to seek to continue to do better so that we can get more business, right? Yep. Take that away and that edge goes away. Well, the continuous freebie goes away.
Let me ask you this, because I was talking about ripple effects with him. Companies like Renew, I don't know if this is true. I guess I'll just ask you. But a certain percentage of what you manage for institutional investors, and is a certain percentage for smaller private mom and pops? Is that how you guys operate?
We're largely institutional at this point. We got a very small percentage of mom and pops.
Yep.
Now we've really leaned into the institutional side just because of what we've built on the asset management, our background in acquisitions and underwriting, and really understanding from cradle to grave how to do what Mark's doing.
Yeah.
Right? And that offers us, we think, a value prop that not many others can offer. We've seen these from cradle to grave, and while we don't always get the opportunity to come in the beginning and weigh in on decisions being made about location, like making sure you can actually order a pizza to the BTR site that you're going to, instead of saying, no, we don't deliver that far out, right? We don't get that opportunity, but we do take on, for lack of a better phrase, kind of cleanup efforts and mop-up duty for folks that Mark referenced on in your conversation, where they had a tough time. They got hurt bad. They, banked on rents continuing to go crazy like they did after COVID, and that just didn't happen. And then they hired a manager who slapped on a multifamily playbook where they've got, 6 people on site that's being all billed back for the manager plus their computers, or their owner plus their computers and phones, where 3 would have done it. And then all, your rents don't hit as well as you thought they would, or your costs are a little higher. You get surprised by, some maintenance problem like your HVAC issue, something, right? Something happens. And then you also got operational fractures in terms of how they execute. You're dead in the water. So again, it's our goal to make it feel like you've got an in-house property management team while you use it.
So and that was kind of where I was driving it. If you think about like the ripple effects of institutional investors coming out of the market, like if institutional investors had to sell their portfolios or they couldn't buy anymore, companies like your company and companies like yours would get decimated, right? And that means jobs, and that means families that don't have an income and that are depending on what you guys do. And I think to NASA and other industries where the government kind of leads innovation, where where would we all be on a space program if the government didn't lead the way for private firms like Elon Musk and other private companies that picked up the government's mantle after they kind of stopped doing what they were doing, and now it's all kind of privatized. So to me, this is a very complicated idea of locking any one type of capital out of the market, because so much is dependent on the livelihoods and also the technology and the progress that those big capital kind of operations have. I don't think the administration is thinking about all of these little things that will happen in lockstep, where if a big move like no more institutional investors buying residential homes that are scatter site or from builders, it just means that all the people that depend on that capital being there, they got to find something else to do with their time and with their lives.
100%, right? I mean, we talked about earlier about a little bit about all the great data that's been coming about the
All for the institutions.
institutional ownership. And I think that you can derive that limiting purchases by institutions or any type of capital investment in the market, it would really have nothing to do on the actual value of homes in the country. But I think on the downside, it could be the kind of lost second point, which I think that you're also, part of what the point that you're making, Adam, is that if you do anything to decrease the rental supply, it actually will, hurt affordability. It'll become more affordable. There's no change to the value of the home. And then you have less rentals, so they become, more expensive.
And not only the rental supply, all of the ancillary services that depend on that stream of capital coming into the market, from property managers, renovation companies, insurance, title insurance, more everything across the board. There's so much that depends on that money being there. They've kind of pulled the rug out from everyone. I don't see it having a net positive effect. In fact, it might have detrimental effects on a whole swath of people that are in an industry that's adjacent to institutional SFR, right?
Ryan, you have institutional clients, so you're very much the network, and I assume friends and colleagues. I mean, we won't hold it against you that you have Adam in your network, but what are you hearing from all your friends and colleagues in the industry about this Trump stuff?
Yeah. It's a great question. I mean, a lot of what Mark said is what I'm hearing, right? It's, hey, it's an easy point to gravitate to. It's easy to dramatize and over exaggerate. It's Trump, catering to the midterms, trying to get the middle class. It's a soundbite that has been for the last several years been, Main Street versus Wall Street. Very, there's some cachet with that, right? So it's going to get you in the news cycle. But think about, to your point, I think, Ted, or maybe it was Mark that made it, the executive order didn't really have a lot of detail in it. There's not really any specific instruction. There's a lot of different theories on how he might actually, or how Congress might actually put this in place and what they might do. But most likely it's going to be something on the back end, like, losing tax benefits or something with depreciation that hurts you and makes the long-term underwrite, less desirable. At the end of the day, though, the tailwinds behind BTR, this could be a positive, right? At the end of the day, all this, what it's chilling. And, he talked about the group that pulled out of a deal, even though it was BTR because they got scared. That's all short-term stuff, in my opinion. I think most of the people I'm talking to, it's just short-term fear and just like, hey, let's just let the dust settle for a second. But at the end of the day, I think people are gearing up and loading up for bear to go after BTR because Mark's right. I mean, you've got people who got hurt. You've got recapitalizations that are going to happen. You've got stuff, people are going to exit the space because they just don't want to touch it and they can get more for their dollar elsewhere. So there's going to be opportunities for other groups that are interested and see the tailwinds behind BTR to go in and pick up existing sites, land, stuff that's already zoned and ready to go. And it's ultimately could be accretive to the whole process and ultimately the renter. It'll take some time.
I'm kind of curious on both your opinions on this, but like I hear that's going to create a lot of people, staying in BTR, but then probably a lot of new entrants to BTR. I've kind of personally viewed it a little bit of a crowded space, up to this point. I mean, I think the times it's been worse than others, but what do you think the end result is in this? Is it more like it's so crowded, like you're at a concert, you can't really see the stage, or is it like a high volume, fast moving river that you have to be in to get somewhere?
I think probably the latter.
Yeah.
I do. I think you're going to have to be able to be nimble. You're going to have to strike quick. You're going to have your stuff together to be able to get it done. And again, that's, back to Renew. That's what we're trying to offer is, hey, if you're thinking about getting into the space, or you're into the space, you need to be thinking about the downstream process partners. If you're not going to become Mark, right, and, AHV, you need to be thinking about how you're going to run this thing, because that's ultimately going to determine your success. So those that get their stuff together sooner are going to be able to run faster and take advantage of whatever, kind of land grab occurs here in the fallout of the EO.
Yeah. And I'll say, like, from the smaller and medium-sized operator, which I work a lot with, we had a conversation, I think at either last IMN or a couple IMNs ago, where like I was trying to figure out how we could leverage a company like Renew to help my portfolio owners actually make deals happen. And it used to be portfolio owners could just sell their assets at a very specific cap rate to institutional or fund investors. And the more I talk to them, the more I got to like let them know, like, you got to get your operations together, because like no one's going to want this thing for anywhere close to market value unless you increase your rents and your places are in such, so devalued because you haven't put the capex into them. I think it's probably high times for you coming up, because like with the market slowing and even capital slowing to the SFR space, like every operator's, what else you going to do when you can't sell your properties? You got to operate them. You got to figure out how to do it better. And the better you operate them, the more money over the long term you're ultimately going to make. It's also a good thing for tenants, because the better you operate them, the better the experience of the tenant and the better lives they lead in your properties.
I think you're right. No, just real quick on that, Adam. I think you're right, man. I mean, that's exactly what we see coming, and why we're out there casting our net as wide as we can. Folks are, I think, looking for, obviously they want operational excellence. They want an institutional grade, asset management function and reporting and visibility. All of those things we can offer. And we've got a great reputation for being a high level operator in the space. But what gets people in the door is the fact that we've got this centralized function, and we are just not going to charge you as much as the traditional third party PM is going to charge you, because of the, our centralized structure. We pass every bit of that savings through to the operator, or to the owner, excuse me. And that just gets us in the door. The rest is on us to, we'll show you our operational excellence. We'll let you dive into our, institutional grade reporting and asset management. Those things kind of seal the deal. But what gets them in the door is, hey, right off the rip, your underwrite's going to look better than if you went for their, bigger name, multifamily manager.
And every renter wants better landlords, right? Like no one likes being part of a landlord, as most landlords are. They don't want to show properties that are just managing themselves. They never fix very much. They're not breachable. And so I see real value in what you guys do, because ultimately it makes people's living experience better. And from the investor's perspective, it actually makes their assets more valuable over the long term. So this has been great, man. I appreciate all the insight. I don't know if you got anything to end with, Ted. I know that at Homestead Affordable, you guys are doing something that requires long-term operations, and this is a subject that probably hits pretty close to home for you. Just curious, give me the high level on what you guys are doing right now in the market, and has your view of the market shifted at all given this new kind of temperature, given the announcement about institutional capital in the market?
Yeah, all high value conversations here today, talking about operations and build to rent. We're specifically focused on taking obsolete properties and bringing them back to top of market standard, and then making them available to housing choice voucher tenants. So I think all in all, we're policy aligned, but I think with, like a lot of people, it's really had a chilling effect on any capital conversation we're having. And I think for somebody like me, it's like that's kind of the downside. At the end of the day, I think it probably very similar to straight build to rent. I think it's probably good for what we're trying to do. Yeah. But the tough part is in the near term, it's just, we don't really know. And I think that people aren't going to act for a while during this period. So it might just kind of have 6 to 9 months to kind of get to those positive outcomes.
Well, listen, man, if you play your cards right, maybe you can get renewed to manage your properties via the NOI of your whole portfolio would go up through the roof, and you'll sell it for a killing. You never know.
I'm dropping it in my deck for sure. We're here to serve.
Yeah.
Right. Thanks for coming on board and having a conversation. So it seems like a very valuable platform. And I've worked with you guys in the past too, long time ago. Sounds like you've had a tremendous more value. So I have to do some business again here in the future. So.
Ryan Killian, Renew Property Management. You're the man. Appreciate you spending some time with us here today. Take it easy. So that was interesting. We had Mark Wolf from AHV, operator of a large-scale built-for-rent portfolio and communities. And we had Ryan Killian from Renew Property Management. Neither one seemed too up in arms and too pessimistic about what this new move in with the administration is doing. So they're kind of, business as usual, optimistic as always.
I know you have Mark, who's the pioneer of build for rent, and it was so interesting to have his perspective, especially right now where that's a focal point of things that are happening in the industry and with the administration, and Ryan's perspective on how they're approaching it. Yeah, such valuable insight, and just really, really great to hear and be part of that conversation.
Yep, great opportunity to talk to pioneers in the space. Love the conversation. Love you, Ted. Can't wait to our next podcast. And this is Adam and Ted Unleashed. Catch you later.